Investors grapple with the idea of the Fed keeping rates higher for longer. Our next guest says that she thinks it's going to be higher until something breaks. I want to bring in Emily Roland. She's the co-chief investment strategist at Hancock Investment Management. What's the number at which it's a tipping point? When does it break, Emily?
Well, we're certainly getting closer and closer. Of course, it's hard to identify the exact number, but we continue to see this sort of unrelenting backup in rates, and a lot of it's based on no news. We see this 6 basis point backup in yields this morning. I'm combing through the news overnight to figure out what's driving it higher, and there's really nothing fundamental there. We are seeing a lot of momentum here. We're seeing a big shift in sentiment. There may be some technical factors at play here, but at some point this is really going to start to challenge the equity markets. We could be looking at some sort of exogenous shock that continues to put downward pressure on stocks from here.
So, but what would that be? I guess we're all trying to figure out if and when that moment were to come. And the question is, are we just waiting for the Fed for another hike? Is that your expectation? Or do you think that they're not going to touch anything to try to avoid this situation?
Yeah, I mean, potentially, and we think the Fed's probably on hold from here. Maybe there's one more hike coming up in November, but there's quite a bit of data between now and then. When you see this amount of liquidity being withdrawn from the system at such a rapid clip, again, there tends to be a liquidity issue. We never know exactly where it's coming from. I think there's a lot of candidates out there that have been talked about on the program, whether it's commercial real estate or crypto or SPACs or the Chinese property market. I think that there's a lot of areas that are over-levered in the market today, and we'll have to see where that comes from. But I think the key from an investment standpoint today is to minimize exposure to those areas that need to rely on leverage, that have to issue debt or equity in this market, and to find companies and screen for stocks that have great balance sheets, more sustainable earnings, better return on equity.
Yeah, but it sounds like under your
portfolios.
scenario, you're going to see. I mean, I imagine you're calling for equities 12 months from now to be lower than they are today. In which case, why don't you just be sitting in cash or doing something else?
Yeah, well, it's a time frame thing, right? So 12 months from now, we could already be seeing equity markets recover as we move through the recession and into the early part of the cycle. But I think over the shorter term, absolutely. And there's one area of the market that's really not priced for recession unfolding, and that is high quality bonds. I know it's scary right now to lean into high quality bonds at a time where rates are rising at this clip, but there has been a ton of value unlocked. We're seeing the highest yields in over 16 years, investment grade corporate bonds, for example.
Yeah, but the highest yields for a reason, 6%. Right?
Yeah, I think so. But again, I think when you see a momentum trade like this, it works like a pendulum. It often shifts the other way pretty quickly here. And I think if we do see prospects for a liquidity event perking up here, you're going to see a bid for treasuries. We're not seeing it right now. It doesn't feel that way. But ultimately, as bond markets reprice for a recession, that fall in yields can be precipitous. So we're expecting that there's going to be a lot of value unlocked in high quality bonds. And even the income there is enough to potentially overcome some choppiness in rates from here as we wait out this very sentiment momentum driven market.
When you say short term, what are you thinking? When you say long term, what are you thinking? If you're talking about the market maybe recovering longer term.
Yeah, I mean, 3 to 6 months ish would be short term. So we look at things like the leading economic indicators index, which have been negative for 13 months in a row. The longest we've ever seen that happen without recession unfolding was about 16 months. The yield curve has been inverted for 14 months. We've seen that happen for up to 17 months. So it's not a perfect science, but you could see a period in which recession, maybe Q1 of 2024, we move through it, and then we get started on an early cycle, and we think that's going to be a great buying opportunity for equities. We want to be patient and wait to get there.
You think it's going to be a shallow recession, right?
Well, I mean, I think that's sort of what everybody's hoping for. We don't think it's 2008, but we don't necessarily think it's great. Right. So we're going to have to see, unemployment is likely to go up here. We're seeing those cracks in the labor market forming. We want to be mindful that the unemployment rate rising is sort of the last shoe to drop here.
My one problem with all of this is if you're suggesting 12 months from now we're actually on the other side of this, nobody's good at timing. Yes, it may get worse in the next couple of months, but if you really genuinely think things are better a year from now, wouldn't you just, stay on the same track?
Yeah, I mean, it's a great point, and we all know that equities are a powerful compounder of wealth over time, and we certainly want to be there. And by the way, I'm not suggesting going to cash. These late cycle environments can feature big moves higher in risk assets, and we want to be there. We want to participate, but it's about owning higher quality stocks. It's about finding stuff that's on sale. We're finding that in mid-cap equities right now, which are trading at the steepest discount to large-cap equities since 1999. We're actually looking at defensive stocks as an area where the baton can be passed as we head into next year. So we want to be there. It's just about managing risk and letting bonds do a little bit more heavy lifting in portfolios as we ride out what I think could be a challenging environment through the next 3-6 months.